Employment in the United States is dipping a little bit. We also see things like inflation. If these tariffs take effect, if President Trump leans into these tariffs and commits to them, we expect higher inflation in the United States. And then we also have GDP estimates, our economy dipping in the United States much below the estimates previously.
Is there anything extraordinary or like a black swanish that you are looking at that might change the course of your investment thesis?
Stagflation is the black swan that we are worried about today, 100%. So in the 70s, stagflation was caused by a supply side shock. That's primarily oil. So in the United States, we had an OPEC embargo that we were dealing with, right? That OPEC embargo took oil prices up 4x. We're seeing that today. We're seeing a supply side shock risk. We're seeing that if tariffs take effect, that affects the supply of the market very dramatically. My favorite play right now in real estate, specifically in the US, single family homes are a very impacted investment class. It's super backed up by the government, super supported by government and government debt programs, and it's a very tight supply side, right? We talked about the baby boomers. They own disproportionately a massive amount of those single family homes, and their plans to sell are essentially none.
Hey, welcome back to Grow and Learn. And we're launching the new show, the Capital Playbook, with my first guest today, President and CEO of the Saint Investment Group, Nic DeAngelo. Hi, Nic, welcome.
Zarina, great to be here. Great to catch up with you beforehand. And I'm excited to dive in today and talk about some fun stuff.
Oh, even more so on my side. Nic, you mentioned you're doing deep dives in economic research and economic outlook. And you're envisioning a great wealth transfer. I know I'm diving deep straight from the beginning, but that's the fun of it. So let's dive deep. What are you seeing in terms of the economy and why wealth transfer and happening now?
Great question. So what we're seeing at Saint, so our company, Saint Investment Group, we're an investment group based on real estate. We focus on real estate, and our goal being to apply economic strategy, apply an economic thesis, and choose the best investment decisions that we see moving forward, right? So part of that is trying to see what the next decade, 2 decades ahead might look like. And while in many ways on a micro level, that's very difficult, on a macro scale, we actually know a lot if you look at the economics of things. What we know, to your point of your question, Zarina, is demographic trends. We know that generations have certain trends that we see over the course of those generations. What you're referring to, which is a very powerful change that's happening not just in the US, but the whole world, are the baby boomer generation, what you're referring to. The baby boomer generation represents somewhere between 72 to 80 trillion dollars in wealth. So they're the largest generation of all time. They're the wealthiest generation of all time. And as they get older, they're slowly passing and handing down that money, which will only accelerate over the next decade, 2 decades, et cetera. So we are seeing, effectively, to your point, Zarina, the largest transfer of wealth that we've ever seen to the tune of, up to $80 trillion passing down from the baby boomer generation. So then the question becomes, because on our side, we focus on investments and trends and, what's happening in the capital markets. The big question is what happens to that money? Who's that money going to? What are the impacts of that money moving through the economic system, the financial system, the investment world? So those are the questions that we've really dove into and really expanded on. But to your point, largest transfer of wealth, up to 80 trillion. That's globally, especially in the US. It's disproportionately impacting the US as well. And we see that going to really interesting places.
The devaluation of not only the dollar, but also other currencies, with the quantitative easing being done continually, actually. What is the value of the wealth transfer? Is it still that much, or is it kind of diminishing over time? Because the wealth that is being accumulated by the baby boomers has depreciated over time.
Sure. So the baby boomers, to their credit, right? They have a lot of impacts that they've changed in society, norms that they've shifted, just like every generation. The baby boomers have invested a lot, right? And so we hear about markets, we hear about the traditional markets, the alternative markets, right? Those are terms that were developed by the baby boomer generation. So the traditional markets that we think of, stocks, bonds, equities, those types of things, the baby boomers invested heavily. So largely, most have actually beaten inflation or currency devaluation, like you're referring to. So my concern's not as much there. Now, the next decade, especially in the US, there are some inflation concerns, tariff impacts. The US is printing a lot of money. We've printed record money in the last 5 years or so. So those are very real concerns. But as they're invested today on the baby boomer side, as long as they maintain returns on their end, then they should be ahead of it. That said, Zarina, to your point, there's some dark numbers, some concerning numbers coming out on the stock market, particularly in the US. You look at Morgan Stanley, you look at Goldman Sachs, you look at some of these really large investment groups, they're projecting somewhere over the next 10 years in the stock market of returns between 0 and 3% over the next 10 years. So if inflation in the US stays somewhere between that 2%, 3% range, it's possible that the baby boomers would go backwards, that wealth would start to go backwards. So we talk a lot about on that on webinars specifically because the old playbook, 60% stocks, 40% bonds, does not appear to be the future of investing as we're looking at it today, with so many things shifting, to your point of the question you asked.
Mm-hmm. You're in real estate. What kind of real estate do you specifically invest in? Do you invest in projects, in real estate stocks? What kind of real estate do you invest in?
So we have worked on 19 projects to date on the syndication side, ranging everywhere from, multifamily to retail to office to industrial. So we've done about 6 different asset classes. We specialize in industrial real estate, primarily historically. But what happened a handful of years ago, our investors said, look, this is a touchy market. We have COVID, we have inflation, we have concerning things that are really messing up the real estate markets in many parts of the US and other parts of the world as well. What we found was that our smartest, most advanced, most sophisticated investors were asking for fixed income. So we did a shift at Saint at that time. We saw some very concerning things in the market, and we have since shifted to an income fund model. So what we invest in today, Zarina, to answer your question, we invest in debt that's attached to property. So mortgages is what we call them in the United States, right? We invest in mortgages backed by single family homes. We typically buy defaulted mortgages or non-performing mortgages. So it allows us to get a discount. We get those reperforming, and then we can get good returns off of those with the strategies that we employ there. So my favorite play right now in real estate, specifically in the US, single family homes are a very impacted investment class. It's super backed up by the government, super supported by government and government debt programs, and it's a very tight supply side, right? We talked about the baby boomers. They own disproportionately a massive amount of those single family homes, and their plans to sell are essentially none. The majority of single family homes owned by baby boomers should be held by the same baby boomers for the next 10 to 20 years, according to the surveys for the baby boomers. They plan to pass away in those homes. So that, among many other principles that you look at on the economic side of single family, we find as the best, most stable asset class. It allows us to provide the most stable returns to investors. So we're focused on fixed income right now. With how turbulent the markets are, with how difficult the markets are, we want to focus on something that pays stable returns.
Mm-hmm. And when it comes to employment data and the fact that many Americans have 2, 3, 5 jobs, I don't know how many these days, they're struggling to put bread on the table, basically. So how is this affecting the ability for them to purchase single family homes and the demand for these homes?
Great question. So there's a few different angles. The first is what you said is how's employment in the United States? Let's take a look at that. The first metric, the most recent study that I read on employment in the United States is that the lowest asking price, the lowest expectation of employees for the price that they would take a job for has reduced by over 10%. So that's downward pressure on earnings. That's downward pressure on incomes. Not good, right? So that shows a weakening, a slightly an ongoing weakening job market in the United States. That said, for what we typically focus on for our personal investment strategy, we're looking at longer held assets, people that have been in their homes for longer because they have more equity, simply put. So they're more invested. They want that home to be paid, to be stabilized. They want to live in there for many more years ahead. Those are our favorite people to work with because we can really work with those individuals and keep them in their homes, which is really our end goal. For other people in the market, especially early homeowners, to your point, the FHA is what we call it, the Housing and Urban Development, the first-time home buyer programs in the United States. Those programs are being disproportionately affected. Those have many, thousands of mortgages that are now in default or some degree of default or behind on payments. That doesn't affect our business really much at all. Maybe even, it actually offers us more discounts. But for the home market in the United States, what we see is first-time home buyers have one of the most difficult barriers to entry that they've ever had for two reasons. One, since 2020, right, since the COVID world that we lived in, home prices have skyrocketed. The value of a home in the United States in many markets is up 50, 60%. These are insane numbers. These are way, way, way high compared to what people were budgeting for previously. And then rates, right? The cost of money has gone up so dramatically that it's double or more in some cases what people were budgeting in the past. So all in all, the estimates of what people will pay on a mortgage on the United States versus just a handful of years ago is over 100% increase. So affordability is tough. That makes supply tough. That makes demand tough. That complicates the market. But if it wasn't already such an impacted market in the United States, that might have bigger concerns. The problem is there's no supply. Nothing's coming on the market. People don't want to sell in a down market. People in the United States don't need to sell for the majority of them. And I think it's somewhere over 40% of mortgages in the United States are 30-year mortgages locked in around 3 to 4%. So a 6 or 7% sell or selling in a market at 6 to 7% rates, they'd have to go buy another home with a much higher rate. They don't want to do that. So they're locked into a degree, and their interest in staying in their homes has increased, which has reduced supply so dramatically. So a lot of things working in the market there. But to your point, it's complicated. Employment in the United States is dipping a little bit. We also see things like inflation. If these tariffs take effect, if President Trump leans into these tariffs and commits to them, we expect higher inflation in the United States. And then we also have GDP estimates, our economy dipping in the United States much below the estimates previously. We're now in the negatives over the next year is the expectation. So between those three metrics, the Federal Reserve, our central bank, has a very tough job. Americans have a very tough job to navigate all this, and investors have a very complicated job right now because they have to reevaluate how their investments are going to do in a new world.
How about the commercial property investment? You said you're mostly focused on residential, but I have heard there's an expected collapse for the commercial property in the US. Mostly due to COVID, but also other factors impacting it.
So that's a very real discussion that's taken place in the United States. I would say that's very limited. So the good news on my side, what the numbers that we've digested, the numbers that we've went through, that's a very limited section of the entire market, okay? That's mostly limited to office because in the United States, there's a very big movement to work from home. So what ended up happening during COVID was this expansion of, it was roughly, I think, 8% of people worked from home, and then all the way up to almost 60% of people worked from home. So there's this huge jump in work from home, and that has slowly went back down. So office is increasing the occupancy, but it's far below what it needs to be in order to be a sustainable market. So I'll break it down for you. Again, my background is in distressed assets. So I've bought with banks, I've bought in foreclosures, I've bought a lot of distressed assets over the years. So we track delinquency data. who's paying their loans and who's paying not, which sections of the market have strong delinquency, weak delinquency, et cetera. Office delinquency, very high, very concerning, right? So that is one section of the market that's still a concern. It's unknown at best, but it's really isolated to one asset class. Next, you go down the list, you look at multifamily. In the United States, multifamily has been really the gem of real estate for many years. It's supported by the government. There's great debt programs. There's great opportunities throughout multifamily. You know, in different markets, up and coming markets, employment trends. There's all kinds of opportunities. The issue with multifamily is many people purchased at expensive price points. They've entered assets at expensive price points, and now their rates are also adjusting upwards, which is putting them in a major crunch. Delinquency in multifamily is up about 10x. So it was roughly 1 to 2%, or excuse me, 1.5%. It's up around the 10, you know, some estimates up to 12%. So it's roughly up 10x. That's a big jump. I don't think most of those will go through the foreclosure process, but the amount of delinquent loans is up dramatically. Now, if you go over to other sections, you look at retail, relatively stable actually. So still high, but stable. So it's not getting worse. It's actually slightly probably decreasing at this point is my assumption. You look at industrial, it's up slightly, but not a lot. So it's not a huge concern on the industrial side. And then you look at residential, it's about even. So there's most segments of real estate in the United States are stable, but that huge jump in multifamily, that's very alarming to me. I think over the next decade it should do well, but today it's very alarming. And then office is very unknown. And that represents big dollar figures. You have buildings worth $100 million plus in many cities. So these numbers look very scary, but it's actually a small portion of the overall commercial market in the United States.
Mm-hmm. And Nic, how is this wealth transfer affecting the average American, the average investor when it comes to the money that they're going to inherit from the baby boomers? Let's say they inherit a house, but they might decide to sell it. Where would they naturally invest in? Some are inclined to go into safe assets, to gold. Some go to crypto. Why do you think real estate makes a better choice or a more reasonable choice?
That's a very smart question. So that's the question of where economics comes in. How can we see some option of the future of where things likely would go, how you can project out? So the best answer I have is this. We see that the baby boomer generation was very focused on what they called traditional investing, traditional assets, equities, so stocks and bonds. What we've seen is really a big breakdown in the bond market. What we've seen is that equities, there's very big concern in the United States stock market, the New York Stock Exchange. We've seen that the stock market in the United States has actually reduced by over 40% of companies since 1995. So it's not the same stock market that the baby boomers were investing in, you know, in their heyday or in their prime earning years. It's actually reduced dramatically. We also see trends of future generations. The millennials and Gen Z disproportionately will inherit the majority of that wealth. The average person who inherits wealth will inherit about 300,000 in US dollars. I think it's 270. So it's a good chunk of money, Zarina, right? These are serious dollar figures. So the question is, what do they do with that? That's your question. What do they do with that?
What do they do with that? Yeah.
The baby boomer generation, rough estimates are between 5 to 10% of their wealth was allocated for investments in real estate. Okay. Future generations trust the stock market and bonds less and trust real estate more. So not majorly, right? We're not talking a 50%, 60%, but we're seeing that let's take a 5 to 10% baby boomer interest in real estate. We're seeing that up to 30% in subsequent generations. So that's a 3x increase, right? So if you took that 30% of 75 trillion, you're looking at tens of trillions investing into real estate over the next decade to 2 decades. So it's a big impact. It's a big impact. So the net impact of that is more money entering the real estate market in the United States specifically. My hope is that that goes 2 places. My hope and what the trends are showing is that it should go towards multifamily and housing because that's a big opportunity that's very impacted in the United States. Cost of living has gone up so high that there's an opportunity for people to be building more housing because the demand and the supply are such in disarray. The second is that Donald Trump and our previous president, President Biden, they pretend that they don't agree on a lot, but they agree on a lot more than people give them credit for. One of those is that building out manufacturing in the United States is a big concern for both of our political parties. So President Biden had the CHIPS Act and many things that were trying to stimulate manufacturing on US soil. And now you have Donald Trump with these tariffs. He's saying very clearly he wants more manufacturing on United States soil. You see Apple Computers committing to $500 billion investment over the next 10 years for manufacturing in the United States. Honda, Hyundai, Taiwan Semiconductors, many big companies moving to the US for manufacturing. So where does that money go? That tens of trillions of dollars. I believe, and I think the biggest opportunity is going to be in multifamily, and it's going to be in industrial real estate over the next decade.
Quick announcement, I'm launching a new show called the Capital Playbook. It's all about real conversations with top VCs, angels, and capital brokers, how they invest, what they're looking for, and where the smartest deals are happening. If you want to be a guest, pitch your topic at growandlearn.org/guest-form. You can also find the link in the description box below. Let's get into it. So everybody's watching with eyes wide open what is happening with the tariffs now in the US. And the big question, I guess, most analysts are looking at is what is the Fed going to do with their interest rates? Because clearly, if production needs to be stimulated in the US, the rates need to go down. But Jerome Powell is not not very inclined to do that.
Yep, that's right.
What is your short-term prognosis on interest rates and how this is going to affect your business?
That's a great question. Let's look at it from a few angles. One, what's Jerome Powell going to do? Well, Jerome Powell's job, the Federal Reserve's job, is what they call a dual mandate. Okay, so Congress, United States Congress, gives the Federal Reserve, our central bank, a dual mandate. It's to manage two economic principles. One is unemployment and the other is inflation. Usually those are a seesaw. So if one goes up, the other goes down and vice versa. Now, rates can affect both. So that's one of the biggest tools that the Federal Reserve uses. The problem is that unemployment looks soft, right? The employment market in the United States looks soft. Also, if tariffs kick in and they move forward, as Donald Trump is telling and saying and projecting and continually supporting, you have this situation in the US, we call it stagflation. It happened in our 1970s. It was a very difficult situation. It's essentially worst case scenario in the economy in the US. In that case, unemployment is high, GDP growth is low, but then inflation is also high. That is worst case scenario. Every economic variable is in the negative, is in the bad territory where we don't want it. In that case, all bets are off. Let me put it that way. We don't know. What we do know for sure is that Paul Volcker, back in the 1970s into the 80s, his solution to stagflation back then was to raise rates dramatically. He raised them all the way up to the 20%, 20+%. So I don't think that's the case here. I don't expect that to be the case here. But my number one thing I'm looking at is what happens with employment in the US. If employment stabilizes and employment remains strong, it's still strong today. There's some early concerns, there's some early warning signs. But if employment stays strong in the United States, then Jerome Powell only has to worry about that inflation piece and then the GDP piece. But really, Donald Trump's kind of steering the ship a little bit more on GDP on many factors. If you wanted me to bet on the next decade, this is what I'd say. Historically, in the United States, roughly we're at 5 to 6% average rates for the last 100 years. I believe we're going to be there for the next decade around there. So wherever it shakes out, I believe that's the average for the next decade that will actually return to the norm, those 5 to 6% rates. I believe that's probably the most balanced market that we exist in today, with the baby boomers exiting the workforce, with them taking huge amounts of money out of the workforce, with the cheap money and the quantitative easing off the table. We're not doing that anymore. I think we return to 5 to 6% rates as the new norm for around the next decade.
What kind of client invests in your company?
Today, our focus is retail investors, so accredited investors. So, the United States, those are typically higher worth individuals, higher net worth individuals. Who we work with primarily, the two groups that we see most commonly for us that are really interested in Saint, we see people that are either moving towards retirement or in retirement. So, that's one bucket is the retirement group. Or we see people with very high net worths that own businesses, they have a lot of money to manage, and that they want to diversify with some fixed income. Right. So with how crazy the markets are, high, low, real estate, many unknowns in different aspects of the market, we see that the high net worth individuals are looking quite a bit at fixed income right now. I see that they like a real estate, a hard, real, tangible asset that backs up that income stream. And they really are leaning into that very heavily. So between those two groups, that's the vast majority of our investors.
I see. Now, going back again to economic forecasting, outside of these normal economic KPIs that you're observing, is there anything extraordinary or like a black swanish that you are looking at that might change the course of your investment thesis?
Stagflation is the black swan that we are worried about today. 100%. So in the 70s, stagflation was caused by a supply side shock. That's primarily oil. So in the United States, we had an OPEC embargo that we were dealing with, right? That OPEC embargo took oil prices up 4x. So a 4x increase in oil. What that did was that every apple that we wanted to buy or every, good or service that we wanted to buy now not only was more expensive to get here, but then also you had to get around and you had to get that home, and the shipping and all the things that went behind every industry were severely impacted. So that boosted inflation, that boosted prices, that crushed employment, that crushed the earnings of companies. So we're seeing that today. We're seeing a supply side shock risk. We're seeing that if tariffs take effect, that affects the supply of the market very dramatically. So that's the black swan, that the number one thing we're worried about today is stagflation taking hold in the United States. If that takes hold, then there are strategies that people can utilize in that environment, but it changes the playbook dramatically. The 60-40 split of stocks and bonds is out the window. Those typically don't perform well in such a volatile environment, and so then people need to be looking other places. They're going to be dealing with in a stagflationary environment. They're dealing with high inflation, problems with companies and earnings, right? So the stock market's going to have big issues. They're going to be having problems with employment. So the GDP is going to be sliding. So it's a very, very funky environment, a very difficult environment for investors in that case. That's the number one black swan that we're worried about right now.
Well, when it comes to crypto investments and specifically platforms like Ripple's platform that is coined as the, I'm just going to throw it out there. Some people say it's the basis of the new financial system, or it's going to be the backbone of the new financial system, whatever that means, all on blockchain, CBDCs and stuff. Do you think this will influence the way the economy is run and the way we look at economic forecasting at all?
So I'll say this. I'm not a crypto professional. I hold a decent amount of Bitcoin, so I do have investments in crypto. As far as the intricacies of cryptocurrency in general or digital currencies, that's beyond my scope. That's not what we invest in at Saint. But I'll say that the technologies are pretty amazing. I'll say that what they have pushed forward with blockchain and many other technologies surrounding crypto, I believe will be absorbed into the market in many different ways. And I think that will revolutionize how we do many things. But for the actual digital currencies, for the actual crypto assets, I'm not the right guy. I couldn't give you investment advice or investment projections on that. But I do think the technologies will be applied in many ways across the market.
Central banks all over the world have actually partnered with Ripple, for example, and clearly there's an intake of this technology, but not openly out there. So there's a change impending if all central banks are working with this company, right? So I know you're not a crypto specialist, but if we can theoreticize what
Sure.
would happen um, if the liquidity is not controlled anymore by neither banks nor the Fed behind the banks, but it takes a completely different trajectory, a
Sure.
completely different path of distribution.
I think in a way, we've had digital currency for a very long time, right? Because in the US, I'll just use the US as an example. When the Federal Reserve prints money, it doesn't print money, right? It's digital, right? And we track that. We have digital ledgers, we have digital ways of tracking that currency already. So to move to a primarily digital system, I think is extremely likely. I think central banks, it's a no-brainer because they can control more tightly the currencies. They can get an up-to-date. There's not a bunch of physical cash or physical bills or dollar bills or euros that are under people's beds in that case. So the idea that a country, I mean, take China, they want very strict controls on their currency, right? We've seen this in the US, multiple discussions one way or the other. So to think that we would adjust more to a digital currency base, I think that's absolutely likely. Do I like that? I don't know. Do I like that? I don't know. I don't know if I would be unsure of some of the impacts of that. I'm not sure of exactly what that would look like. But do I think it benefits central banks? And do I think central banks would prefer a primarily digital currency world? 100%. 100%.
Okay, Nick, let's go back for the last time before I let you go to
Their Saint investment. Yep.
Saint Investment Group. You have at the moment, I believe I read 19 real estate development projects in your portfolio. Are these all your primary focus, single home developments or something else?
The majority are industrial projects that we've done.
Uh-huh.
So we have we have seven full cycle and then the remaining 12 that are still in the portfolio today. So we still actively manage those. We're still very involved in asset management. I have asset management meetings later today to go through that portfolio, as well as our portfolio of over 500 mortgages as well. So we do both is the answer. We do both is the answer. We're not acquiring more industrial at this section or at this point in the market today, but later this year we plan to buy more industrial to invest in the manufacturing build out in the United States. I think that's a huge trend that's extremely huge opportunity moving forward. And so that's our focus in the near future is to move forward with both of those. It gives our investors a lot of opportunity to invest in a few different strategies on their side, whether that's in growth, whether that's in income, whether that's some in tax advantaged investments that they can lean into. And so with our higher net worth investor base, with our retirement, focused investor base, between those two demographics, they really, really, we want to check as many boxes for them as we can in the real estate space.
Mm-hmm. Okay, one very last question. When you say industrial, do you include information technology like data centers build up in this category?
We have not invested in data centers yet, but I'll tell you a secret, Zarina, is that we are looking at some data centers now. Many of our investments in the past have been a little bit more complex. So they've done things like huge power upgrades. We've dealt with solar deals. We have a solar deal on the table today to offset some of the utility costs. We've evaluated or invested in many things that lead in very well with asset classes or subclasses like data centers. So we are looking at that. We're evaluating that now as a good opportunity. I think that's a huge opportunity moving forward. And I want to be on the right side of that opportunity for sure.
Mm, fantastic.
But
Thank you.
But
Mhm.
the bread and butter of what we've invested in industrial historically has been manufacturing and distribution warehouses because between the different ports in the United States and how much we import and how much we manufacture here, we like that infrastructure very well.
Fantastic. Thank you so much, Nick. Great conversation. Very interesting outlook, very in depth. Thank you very much. I really enjoyed it. And thank you for being my first guest on this new show.
Absolutely. I know the show's going to be amazing. And again, I had a lot of fun today. We do economic webinars every single month. So if someone wanted to learn more, if someone wanted to hear more of a deeper dive into all the topics we covered, they can check out saintinvestment.com/resources. We have a whole bunch of webinars that are hour long, 2 hours long, diving into each one of these topics, as well as how to invest through these trends that we're seeing. We're doing all this research already. So we post all of our findings at saintinvestment.com/resources.
Fantastic. Thank you so much, Nic.
Thank you, Zarina. It's been great today.